Markets posted their second consecutive weekly loss this week, with Friday's sell-off leading to a 1% weekly fall in the Nifty. However, the PSU Bank Index was a standout performer, and that helped to give gains to the Nifty. Hello and welcome to Taking Stock, the show where we will review the week gone by and prepare you for the next trading week. I'm Lata Venkatesh, with me my colleague Prashant Nair. Hi.
Hi, Lata. I mean, it's an interesting juncture in markets, right? I mean, the market is down 400 odd points from the all-time highs, but there is still so much bullishness around. I mean, the broader market is doing well, and it's going to be an interesting chat over the next 30 minutes or so. We have a whole host of market opinion to help us assess the week gone by, but more importantly, tell us what lies ahead. Andrew Holland, CEO of Avendus Capital, is our fundamental market guest, someone who's run a alternate strategy, long short fund in the market for a while, and he'll be apt to assess a market like this right now. Rohit Shrivastava is our technical strategist for the show. He's, of course, founder and strategist at indiacharts.com. And as always, we'll get you the best opinion that we got through the course of the week. So you'll hear from Hugh Young, one of the largest India foreign fund managers. Gautam Dugar, head of research institutional equities at Motilal Oswal Financial Services, will be the local big voice that you will hear on the show. Lots packed in. Well, let's, as always, wrap up the week itself in terms of what really happened. Lata.
Well, actually, I would say this is the week of creaming the gains, as it were. And that's true globally, across all markets. The first 2 weeks of February, say actually February 1 to February 15, I'm including 1 day of this week as well, you saw absolutely stellar gains across the world, and India was at the forefront, with the Nifty gaining something like 12% at its height on Friday from the lows, the starting point on Feb 1st. And what we've lost is maybe about 2.5% from the highs, which is, par for the course, actually, because it was an extremely unnatural gain. And some profit taking is actually healthy for the markets. The catalyst for this change of scene was the US yields. You saw US yields, they've been climbing up all the way from December. It was 0.9 for the 10-year, and today it stands at 1.3. It's been climbing, but you saw a sudden 10 to 15 basis points jump in this week, which made everyone sit up. The connection is that people were not getting into US treasuries because they are the safest instrument, because they gave you next to nothing. You waited for 10 years and you got less than 1%. But now, as the risk-free return increases, then you're going into all the risky bets. And from a US point of view, emerging markets is a risky bet. So you're going in search of yield. Why should I go there when the yield at home is improving? So the fear is always there that when US yields rise, money will move out of emerging markets. But as I would venture, this is too small a gain for too much money to flow out, and that is proven by the fact that every day we saw an FII positive number. But nevertheless, that was what played out in the week. But Prashant, before I come to you, maybe I should invite Mangalam to tell us first what were the leads and lags, who were the leaders and the laggards of the week. Mangalam.
Well, this week was reserved for some sort of profit-taking on the front line indices, both the Nifty as well as the Nifty Bank, as we enter into the expiry stretch. But the biggest gains were reserved for the PSU pack, the PSU banks, as well as the entire PSU pack. So the PSE index actually up by almost 6 odd %. Among the top gainers on the Nifty, 4 out of 5 gainers belong to the PSU pack. The gas stocks doing rather well. So we had GAIL, ONGC, NTPC, Power Grid, all of them running the Nifty this week. But the ones that took a backseat were the quality names. So the losers, we had all of them which were high valuations. So maybe some profit taking or some scale back in terms of moves took place out there. The likes of Nestle, Cipla, Titan, even Eicher Motors. The nature of gainers in the F&O space were also not too different. PSU banks really shone through. Bank of India, Union Bank, Bank of Baroda, all of them putting up a strong show this time around. And again, the nature of losers were the high-value quality names, the likes of Page Industries, Voltas, Amara Raja, Vodafone Idea, of course, losing a fair amount of subscribers as well. But the biggest gains were reserved for some of these names like Central Bank, IOB, GIC. Hold your breath, 44 to 60% gains in just 5 trading sessions. New India, the investors of happiest minds would definitely go into the weekend with their happiest mind in terms of gains, because 35% in the last 5 days. So that's exactly how this week went.
Okay, well, fair point, Mangalam. When the price of the stock is about 12 rupees, then to rise 50% is a little easy, which was the case in IOB. But Prashant, you've been studying the trends and you pointed out day after day how the US yields turned the tide. What does next week hold for us?
So let me start with the Nifty, Lata. So the Nifty is down 427 points from the all-time high, and it's clearly in a corrective phase. Very simply put, when you look at technicals, price action, the Nifty is making lower lows. Every day it goes down below the previous day's lows. That's clearly bearish. I would say the price action on the Nifty is a little confusing. It's not clear. Can you say that it's headed 500 points lower? I don't think so. The reason for that is something I've mentioned all through the last couple of days. Starting from Wednesday, Thursday, and then Friday as well, which is the fact that the broader market is doing, very good. Even though advanced decline for 3 straight days running has been poor, volumes have exploded for stocks which are going higher, and the list is long every day. You compare and contrast that with the longer number of list of stocks which is going down, volumes are thin there. So that's why I'm saying the Nifty may be a bit of a mirage. You've got to look beyond that. That's point number one. I put this chart up, and the market, maybe that was an indication the market started correcting from that point on. The US 10-year basically is at a point, it's that horizontal line, which is the lows of 2012, 2016, and then early 2020 as well. That level stands at, it's a horizontal straight line, 1.32 to 1.38. We are just under it. So far, last 2 days, Thursday and Friday, Wednesday and Thursday in US market action, yields spiked in the course of the day, got to about 1.3, which is the day high, and then turned back down again. So we'll need to see if it goes through this line or it actually heads lower. That's point number two. Gold also, by the way, is at a very pivotal support level. It's at about 1765. We're right there. So let's see if that breaks. If it breaks, it may be headed a lot lower, $100, $200 easy. China has returned from its Lunar New Year holidays, and that's essentially brought about a lot of enthusiasm in industrial metal prices. Even on Friday, when stock markets were lower, if you looked at prices of aluminum, copper, nickel, they were all up between 2 and 4%. And that's why, commodity, non-steel stocks actually held their own in Friday's session when everything else was down. So, it's an interesting mix of factors, I think, but the big one from a global perspective is going to be whether that 1.3 to 1.38% on the 10-year holds or it gets taken out and yields head a lot higher. Lata.
Okay. Well, that's the point. We have to see whether, at what point support comes in. My sense is that in early, when an economy is turning, the early increases in yields are usually equity positive. There is time before the whistle is blown. But let's wait and see how things pan out. And let's defer to expert opinion. We spoke with Hugh Young of Aberdeen. Aberdeen is one of the biggest investors in India, foreign investors in India. Hugh Young says that while this has been a fantastic run for the markets with improving fundamentals and earnings, caution continues to remain on valuations. That's his call. Listen.
It has been a fantastic run that we've seen. Obviously, fundamentals are improving. We're seeing our way out through the COVID disaster into improving earnings, and those are coming through quite visibly. The issue for us, of course, is price, because as you correctly say, prices have run extremely hard and fast. So when you look at where the market was nearly a year ago, we've seen some phenomenal returns, in many cases, stock prices doubling. So our caution tends to be on the valuation side.
Okay. So, well, everyone has this problem with valuation. So let's ask our expert who's joining us, Andrew Holland, the CEO of Avendus Capital Alternate Strategies, is with us. Thank you very much, Andrew, for joining us. Well, that really is the first question. Do you think we are headed for a major shakeout because of the yield issue, and we could go, lose another 10% or so? Or do you think support is nearby?
So I think I kind of have been agreeing with Prashant all week. Actually, he's been sounding the alarm bells on the yields, and markets remain complacent about it. But if you just think about it, right? The Fed's put what, $7-8 trillion of printing money. And within a matter of a month, the yield goes from 1% to 1.3%. So if you're looking for the Fed to bail you out of this one, I'm not sure. I mean, we talked about it before, Latra, in that there's a container problem around the world. Oil prices are higher, commodity prices are higher, and as soon as lockdown eases them up a bit more, then people are going to be out spending, and that's going to push prices higher. So I think the yields are telling us something, and the alarm bells are ringing. And if you look at what's happened in the US in terms of the markets, obviously the growth stocks are taking that on the chin as yields go higher. So if you take one of the bellwether stocks there, Tesla, I mean it's down 10-12% so far this year. Now you wouldn't have thought that, right? But it is. So if you get that kind of fall from growth stocks globally, then it will affect our markets. You could see that very quick kind of move to risk-off trade. What am I talking about? Probably a 5 to 10% kind of fall that you could see as markets digest where interest rates are really going. Listen, I'm in no doubt that any doubt that the central banks will keep rates lower for longer. But the markets will start to work out when they're going to increase rates, and that's what you're seeing these wobbles in the markets already globally, and now even with our own yield here at 6.1, we're kind of ignoring it, right? It's there, it's increasing, and so is inflation.
Andrew, what do you do now? I mean, if you are a long-term investor, then you just sit tight. I mean, you've seen the COVID correction and you sat through it and the prices have all come back, and I mean, this is nothing compared to that. But if you are trading, these kind of moves can seriously hit your P&L. What do you do?
Well, I think you have a couple of choices. You can sit on the sidelines for a little bit and just let it kind of pass through, or you keep very high hedges. To protect yourself. I mean, yes, the worst case is that if markets kind of, bond yields go down and markets start moving up again, you miss some of that upside. But you protected yourself just in case, right? And at the moment, it's the just in case which I think you need to worry about, because globally markets anyway are looking overboard, have been for a little while now, it just seems that the retail investor is having a field day, and at some point, again, that will stop, as we've seen in quite a number of stocks in the US. So there's going to be pain somewhere. But, I think what worries me is that we're all consensus in terms of our views, and something will happen usually outside of that. And, when liquidity is sloshing around in so many different places, some pain something will come out of that which we won't like. Now, I'm not sure where it was. Last month it was all to do with GameStop, right? Yes. I mean, who would have thought that? So, it's going to be something outside of where we are today, just outside of interest rates, inflation, commodity prices. It'll be something where that bubble's hit. And you know what I think it is? Not as though I'm an expert on it, but these special acquisition companies which are listing, and obviously you don't need to have any forward guidance apart from saying we're going to the moon and back. It seems very bubble-like to me.
Well, there's Bitcoin for company. But we'll come to that. The other issue I wanted to speak to you about is the just concluded earnings season. Gautam Dugar, the head of research of institutional equities at Motilal Oswal, has done this research of putting together all the numbers. Just listening to his key findings, and we are coming to you, Andrew.
Upgrade to downgrade is massively in favor of upgrades. The ratio is 7:2. So for every 2 companies, we have downgraded earnings by more than 5%. We've upgraded by 5% for 7 companies. In our universe, there are 70 companies which have seen upgrades of more than 5%, and just about 19 companies where downgrades are about higher than 5%. And this has been the ratio even for 2Q FY21. So clearly, the earnings momentum has spilled over into third quarter of FY21. 2 months back, we were all wondering whether the growth that we have seen in 2Q FY21 of 17% in Nifty earnings will sustain or not, because large part of it, people were saying, was led by cost benefits, and therefore it is not sustainable. On the contrary, we have seen third quarter Nifty growth of 22%, which is even better than the last quarter's performance.
Okay, so there you are, Andrew. In Gautam Dugar's assessment, this year EPS, Nifty EPS will grow by 16% by the time we hit March 31st. Next year, he's estimating a 34% rise, and FY23 a further 20% rise. Is this solid support? What is your assessment of earnings season, and where will you look for safe harbour?
So I think they've all changed around their kind of assumptions, right? I think if you go back 6 months, I think it was more like 20, 25% and then 30% the year after. So, they're changing it around in terms of the mix. I think, where you see these upgrades and so forth. I mean, first of all, the earnings season was again very good, and I think it's all to do with operational gearing. And again, the market just doesn't kind of get operational gearing. So even though we were worried a little bit about increasing wage costs and maybe some input costs, the operational gearing took care of that in terms of, as you get more throughput, then your costs aren't rising as much. And I think that will probably, hold steady for another quarter. But I think input costs will start to bite into margins going forward. So I'm not sure about 33%. I'm more like 25% for next year, and probably 20% for the year after. But that doesn't take into account the year after. I'm talking about 2023 now. If the government's infrastructure program and expenditure does happen, real estate does continue to pick up, then the multiplier effect will be a lot higher than I would be expecting at this point. So I could see earnings maybe in 23 being a lot better. So I think whichever way I look at it, in 3 years' time, you're probably on a P of 14, 15 if you look back in 3 years' time. So it's probably not overly expensive, the market, but I think where we are today. In certain sectors, you're taking, and we saw it with a set of results from one consumer company, the other day, where, obviously the costs of advertising and brand promotion is taking some of that margin away. So it's already starting to happen in certain industries.
That's right, Andrew. Thank you very much for your analysis of the earnings season and of this upgrades hysteria that we are going through. Let's see where this creaming of profits is going to stop. Thank you very much for joining us. Have a great...
Okay, welcome back. You're with us here on Taking Stock. We've been running you through the fundamental opinion in terms of how the market is poised. But some stories from last week will continue into the week ahead as well. The PSU Bank Index by far was the biggest story. I mean, stocks went absolutely berserk. Notwithstanding Friday's correction, the PSU Bank Index, the index is up something like 13% Friday to Friday. Well, what has that led to in terms of valuations now? My colleague Abhishek Kothari is standing by with exactly that. Abhishek.
PSU banks were on investors' radar this week. The Nifty PSU bank has given a return of 12% versus flat for Nifty bank and minus 0.8 for Nifty. So PSU banks have given an average gain of anywhere at and above 35% for the non-merged PSU banks. So from the lows to the highs in the week, the gains have been anywhere between 24 to as high as 73%. So who was the top gainer? The top gainer was Indian Overseas Bank, which has given a return of 55% on a week-on-week basis, followed by Central Bank of India at about 54% gains. So the valuation change on a week-on-week basis was the highest for Indian Overseas Bank, which went up to 4.5 times when compared to 2.9 times in the previous week or last Friday. So however, from the lows of the week to the highs of the week, the top gainer has been Central Bank of India, which has given a return of more than 73%, followed by Indian Overseas Bank, which has given a return of more than 71.5%. So if you take a look at the pre-COVID levels and right now where the stocks are trading at, the top gainer has been Bank of Maharashtra, giving a return of 150%, followed by Indian Overseas Bank giving a return of 141%. The returns are not bad because even UCO Bank has given a return of nearly 45%. Back to you.
Yes, just a point of caution, which Abhishek did mention. Many of them are penny stocks, they're less than 20 rupees in cost. So gains can look outsized and valuations have been cheap, most of them trading below half-time book. Let's get your expert opinion on public sector banks. Hugh Young, again, of Aberdeen, one of the best watchers of the Indian equity skies, says that State Bank has performed exceptionally well, but he missed out that rally. Listen in.
SBI we've looked at closely, but always preferred to stick really with the private financial institutions, the Kotaks of this world, HDFC, which we fell for. Oh gosh, it must be the best part of 30 years now, which has done fabulously well. So we've tended to stick away from the state banks, although SBI has performed exceptionally well. So we've missed that one.
Okay, let's take it to Rohit Shrivastava, founder and strategist at India Charts, who's joining us. Rohit, thanks very much. Great to have you here. You said there is a pullback likely last Friday when we spoke. I mean, Monday and Tuesday markets rallied on, and then they finally obliged. And we are right around where you said the Nifty should be at, maybe a little lower. What's your sense now?
Yeah, so good to review that. And I think we've done a 23.6% retracement of the entire post-budget rally. And that's the level we are at, just below the 15,000 mark. The question that will arise in the mind, are we going to do something bigger or deeper? And it's going to be a little hard to answer that. What we can really focus on, though, is that the larger trend up remains intact, and which is the fear that seems to arise in everyone's mind every time there's a small correction. So I think it's too early really to say that something has ended. What we would look at this as correction. So it's a question of, do we stop at 14,980? Do we really go back to maybe a 30% retracement, which will put us closer to the 20-day moving average, which is at around 14,780. There's no clear evidence of whether one will happen or the other. And since you've actually declined for 4 days, it's pretty steep already in terms of time, because most of the short-term corrections have not gone on beyond a couple of days. So and also you get these routine corrections ahead of expiration. So putting all that together, I would like to think that we've seen the worst today, but I'll actually look for a confirmation of that on Monday with the market actually turning up. So once it turns positive, I think we'll get that confirmation.
Stock advice?
Wait and watch. So the focus has to be stock specific, which is what it was this week also. Even when the correction started, we've seen the metals and PSU stocks do extremely well. And I think those two sectors remain on fire because both of them are showing very strong trends. So every time you see a decline in those sectors, you're going to see buying come in again and again. Specifically for next week, I would focus on metals. And the reason being that we are actually seeing the dollar fall off this week again, very close to the 90 mark from where we bounced. And that's clearly spilling over into commodity prices, with copper prices up more than 2%, aluminium prices up almost more than 1%, and nickel also almost 2%. So I think the commodity rally should be attracting a lot of attention and should spill over to metals. The moment the market stabilizes, you'll see metal stocks do well. So I would focus on that as a sector going into next week.
All right, Rohit, thank you very much for that advice. Have a great weekend yourself. And from Prashant, me and the entire Taking Stock team, here's wishing all of you a very happy weekend.
Thanks very much for watching. More coming up on the other side.